Thank you for joining Justin Rhodes and myself, Hillary Watkins, for this WCU ENT 640 discussion of balance sheets. Again, my name is Hillary Watkins with Team Hotel, and I'm going to discuss exactly what a balance sheet is and the function it performs for a business. First, let's discuss why it's called a balance sheet. Well, it balances. Two sides of a balance sheet are the assets and the liabilities. As you can see, on one side it shows the things that a company owns, the assets, and the other side is where the money comes from to pay for these things. It's called their liabilities, and it can include anything such as debt, money borrowed, any shareholders' equity, things like that. A simple way to remember this is by the accounting equation here. Assets equal liabilities plus equity. Now let's discuss each of these segments that make up the balance sheet. First, assets. Wikipedia describes assets as two categories, tangible and intangible. Anything that's capable of being owned or controlled to produce value is considered an asset. These represent ownership that can be converted to cash, and the cash itself is also considered an asset. Tangible assets include current assets and fixed assets. As you can see here, we've got the tangible assets, the intangible. The tangible is broken down into these current assets and fixed assets. We'll discuss the intangible in just a moment. The current assets is inventory, prepaid expenses and accounts receivable, and cash equivalent. These are things that can be expected to be converted into cash within a year or an operating cycle, and they're continually turned over. Fixed assets are things such as property, plant, and equipment. They're items that have been purchased for long-term use in business activities. Land, building, machinery, furniture, tools, these are all called fixed assets, and they all have a future financial benefit that's probable and usually can be measured reliably. They're also depreciated over the useful life of an asset through accounting. Now let's look at the intangibles. When you break down the intangibles, you can see anything that is really not something, like the name says, that can be touched. Trade secrets, any copyrights or anything that a company has converted like that to produce money from business activities. Brand distinction, something that a lot of companies work for very long periods of time to kind of, develop. Coca-Cola has this very distinct brand that is worth, a very unknown amount of money, but it's something that's intangible. Intellectual property, the trade secrets behind Coca-Cola, and the human capital, the people that work there. Those are all considered intangibles. Liabilities, on the other hand, are obligations from past transactions that result in transfer of assets. This flowchart you can see shows that there are current and long-term liabilities, similar to the current and fixed assets that we talked about earlier. Payables, accounts payable, these are current things that within a year are expected to be turned over. Long-term liabilities such as bonds, notes payable, long-term leases, pension, and long-term product warranties, these are all things that will result in obligations for long-term money down the road. Equity is something that's also part of the liability side here. It's a residual claim on interest after all liabilities are paid. Shareholders' equity is spread amongst a large group of investors. So when you look at equity in businesses like the businesses on the stock exchange, you can see that this money is spread amongst a large number of investors, and that's what Wall Street is buying and selling all the time with investors who are putting equity into the company. Startup equity is the capital an entrepreneur will put into a business venture to get things going. So that's the kind of money that as entrepreneurs we'll be looking into with angel investors, anything that we can get to put into the business to get the ball rolling and to get us working on our business venture. So how do these parts work together? Now, Investopedia has a really great video that sums up how these parts work together. It's laid out a little differently than I've described here because they say that there are 3 sections versus the 2. But you will get the gist of the the information. So let's take a look at this video. Go straight to the Investability, the Investopedia site. And here we go.
Hey, a triple bottom looks like it's ready to break. And I'm catching it all with Charles Schwab. Street Smart Edge with Screener Plus lets me custom build my own screens or use predefined ones. Now that's what I'm talking about.
A balance sheet is a statement of net worth. It's broken up into 3 sections: assets, liabilities, and equity. A equals L plus E. Meet Joe. Joe goes to the bank and gets a small business loan. The bank gives him cash. On the balance sheet, his liabilities increase by the size of the loan and his assets increase by the same amount. The balance sheet remains in balance. Joe uses the cash to buy a truck and start his own pizza delivery service. His cash assets decrease, but that's balanced by an increase in his other assets, a new truck. As Joe delivers pizza, the profits are recorded in the balance sheet as retained earnings in the equity section of the balance sheet. The cash from his profit is recorded in the assets section, balancing out. Every month, Joe makes a payment against his loan. He reduces his liabilities by the amount of the payment, and his cash is reduced by the same amount. To find out his business's worth, Joe subtracts liabilities from his assets. This equals the net worth of his business.
So this provided some good information about the what the balance sheet is and how the parts work together. So is that the same thing as an income statement? Not at all. They are both part of the 4 basic financial statements, but the balance sheet references a single point in time, whereas the income statement references a period of time. So now let's take a look at a balance sheet and an income statement for Caterpillar. We go to Caterpillar's site here on Morningstar.com, and you can see the income statement where it takes the revenue, takes out the operating expenses, and this is all shown in years. So you can see the entire year for 2007, 8, 9, 10, 11. And you do take out a lot more information. You can see the net income available and their operating income. So it does take a little bit more depth into how everything is paid. It shows any activities and the amount of money that came in from sales and operations and the amount of money that goes out in the form of expenses. So it ends with the net income as the bottom line here. And like we did say, it is for a period of time. But when you take a look at the balance sheet, you can see the current assets here. That will show you the cash as well and the total current assets. Here's the property, plant, and equipment. Here in the intangibles, you see the equity, goodwill, and there's the total assets there. Here's the liabilities, where they're taking out the current liabilities and non-current, the total liabilities minus the stockholders' equity, which we discussed is the money that's put in, and then it balances. As you can see, the total assets here, 56,132, balances with the total liabilities, 56,132. And for each of these periods that they described here, these points in time, they have all balanced their liabilities versus their assets. So, in conclusion, the balance sheet does reference a single point in time. It can be for a day, it could be, for a month, however the business is looking to see and track their the way their assets and liabilities are working together. It does balance to show exactly what you have and what you owe. So it does allow you to see exactly how the business is performing. And it does allow you to track the net worth for different period, reference different points in time. So if you wanted to look at month over month, you could see overall how this is working before the end of the year. So with that being said, Justin Rhodes and myself would like to say thank you for watching this presentation, and hope you have a wonderful day.